All right, let's get started. Good afternoon, everyone, and welcome to today's educational course on the wheel strategy. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay. And for the next hour or so, I will be covering a deep dive into the wheel strategy itself. Now, when it comes to the wheel strategy, at least in my opinion, I do view it as a combination of, longer term investing with stocks and also options trading. And it's really the best of both worlds, because not only do you get the capital appreciation for the long term when you're essentially long the stock, but you also get to generate a consistent income stream for your portfolio. So you're putting your long stocks to your longer term investments to work by generating that income stream. And you're also consistently reducing your risk in the meantime. So quite a lot to get through today. And before we get started, just a quick disclaimer. The types of securities, loans, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, well, we are going to dive right into the wheel strategy itself, just analyzing it from a high level. What are the key components of it and how it works in a nutshell? From there, we'll be moving on to the two components of the wheel strategy. So we'll be reviewing the cash secured puts or cash covered puts and covered calls. So for all those of you that are quite new to options trading or new to income or generating income with options, just to get you onto the same level as everyone else, we'll be going over the two basic components. And from there, we'll be going over an example of the wheel strategy itself, so putting the theory into practice. We'll also be looking at what, in my opinion, is potentially the most important aspect of today's session, is the optimal covered calls and cash secured puts. And that's with reference to selecting the optimal strike prices and selecting the optimal expiration dates, because this strategy is very much dependent on strike price selection and even expiration date selection. So we will be spending some time there. And finally, we'll be covering the OptionsPlay reports. So these are reports that we generate for you on a daily basis that can help you and save you time and help you select the most optimal covered calls or cash secured puts, so you can really maximize the wheel strategy for your own trading and investing. So the main question that I want to be able to answer for you today is, how can I maximize yield and participate in capital appreciation using options? And many options traders still hold the majority of their portfolio in stocks, and they have a longer term view on certain stocks. And this strategy is really applicable for those investors that have a longer term view on certain stocks in their portfolio, and just to really maximize generating income from those stocks and just maximizing yield overall. So what is the wheel strategy? The wheel strategy is, I would describe it as short-term bearish, long-term bullish. And it's a strategy that allows you to create a continuous income stream while also purchasing stock at a discount and participating in the capital appreciation of that stock. So quite a lot to unpack there already. But if we take a look at the diagram on the right, this is essentially visual representation of the wheel strategy itself. There's two main components. They're covered in green. That's selling a put option to collecting premium and selling a call option to collecting premium. And the first step for the wheel strategy is to actually sell a put option. And this is known as a cash secured put. So you are reserving some cash as collateral to actually buy the underlying shares in the event that you get assigned. And once you sell a put option, there's really two outcomes that can happen. Either the put option can expire worthless. This happens if the underlying doesn't move below the strike price and you don't get assigned. So it stays above the strike price, or temporarily moves under it and then back above it. If the put option gets assigned, you get to keep the full premium, and you simply rinse and repeat the strategy. But remember, when you sell a put option, you are obligated to buy the stock from the option buyer, and it's 100 shares of that stock in the event of assignment. So you're not, like Jay said, you're not the driver of this trade. You're more of the passenger. It's the option buyer that decides if he or she is going to exercise his or her right to sell the underlying. Now, in the event, again, of you getting expired, expiration, this is a rinse and repeat strategy. So you can simply sell another put, collect more premium, and continue to rinse and repeat the strategy and keep collecting more and more premium until you get assigned. So once you get assigned, you purchase that stock, but the premium that you've collected throughout the time of selling all these put options, that can essentially be used to offset the cost basis of you buying that stock. So once you are assigned to buy and you buy the stock, you're now long 100 shares of the underlying, and from there you then move on to the second step of the wheel strategy, which is to simply sell covered calls. So selling a call option that allows you to collect some premium, but it creates the obligation for you to sell those shares should you get assigned from the option buyer. So again, there's two outcomes here. The call option could expire worthless. So this means that the underlying stock did not rally enough to surpass the strike price by expiration, and the call option expires worthless. So in this case, you get to keep all the premium and you get to rinse and repeat that strategy of selling the call option against the underlying stock and keep generating more and more premium. And let's say you eventually do get assigned. From there, you have to sell that stock and to the option buyer. And this whole process is a rinse and repeat as well. So even though you have these two main components, which are essentially two separate income strategies, the wheel strategy essentially combines both of these strategies into one. And that way you get to create a continuous income stream from selling the put options and selling the call options to collect premium. But you also get to purchase that stock at a discount, because remember, by collecting all the premium, when you do get assigned to buy the stock from the put option, the cost basis is reduced thanks to the premium that you've collected. And when you are long the stock, you get to participate in that capital appreciation of that stock. So you have that exposure to profit from a move higher in the underlying itself. So why would you use the wheel strategy in a bear market? And this is a very good question, given the current landscape, given current markets where we are in a bear market. We've seen a significant decline across the board for pretty much most of this year. So why would I want to use a strategy that is essentially bullish and that involves buying a stock? Well, the simple answer to that is there's actually two answers, but the first answer is to simply buy the dip. I mean, market declines provide an opportunity to buy stocks at a cheaper price. I think that's fairly well known. And just an interesting fact, half of the S&P's 500 strongest days occurred during bear markets. So when you use a wheel strategy and when you do get assigned a stock and are long 100 shares of the underlying, you get to participate in the strongest days of the S&P. And a very good example of that was just last week after the inflation or the CPI data came out. We had the biggest one-day gain in the S&P since March 2020. So you get to participate in that by being long the stock, even during a bear market. Now, the one thing to remember about this, and this is something I'm probably going to be repeating quite often, but it is a very important aspect to the strategy, is that you have to have a longer term investment horizon. That is very important for the wheel strategy, because remember, at the end of the day, you're going to be long 100 shares of the underlying, and you only want to use the wheel strategy on stocks that you're comfortable with having a longer term investment horizon on. And in a bear market, you're comfortable in seeing that stock turn red for a little bit, but you do believe in the longer term thesis that this stock will become more valuable in the months or even years to come. So having a longer term investment horizon is very, very important for the strategy. And that's why the strategy works so well for investors that have portfolio holdings that they want to either expand on or they want to generate a more consistent income stream on. So just to illustrate what I mean by this is a monthly chart of the S&P from yesterday all the way to 1998. So we have about 24 years here worth of price action. And if we take a look at the market dips, we have the dot-com bubble, we have the global financial crisis, we have pandemic drop, and we have the current bear market that we're currently in. Now, the first thing I'm sure you all notice is the fact that over the long term, equities do move higher. The S&P has continued to move higher and higher and higher. And in the grand scheme of things, these market declines meant very little in the years to come. And this is where the real strategy is very powerful, because even if you were to have utilized a real strategy halfway through, let's say, the dot-com bubble, and you purchase a stock at around 1200, because you are using options to create an income stream on top of that, you're reducing the cost basis from 1200. Even during a market decline, you're still managing to reduce that initial cost basis and that initial break even lower and lower as the days or months go by. And by reducing that break even, this trade, or at least the stock part of this trade, becomes profitable sooner. So when we do eventually get capitulation and a market rally, that break-even point is hit much sooner. So when you reduce your break-even, you also reduce your max risk, because your max risk when you buy a stock is the price at which you bought it for, because in the worst-case scenario, that stock can move down to zero. But by continuously reducing that cost basis, by generating income, offsetting it against the cost of buying the shares, you get to reduce your max risk while generating that income stream as well. So the second reason as to why you would use a wheel strategy in a bear market, well, that has to do with volatility. And volatility becomes elevated during times of market decline. And when volatility becomes elevated, options become a lot more expensive. And I know Jess did touch up on this a few minutes ago, but options become more expensive. And in that case, you'd much rather be a seller of options than a buyer, because you'll be generating more premium by selling, and options will be generating more premium in general. So volatility indices like the VIX and VolQ, they provide a more broader base gauge of implied volatility. The VIX looks at the S&P options, and VolQ looks at the NASDAQ 100 options. There are some subtle differences between both of them, but if you want a broad base gauge of volatility, those are the two indices that you could use. However, if you want a more granular metric for implied volatility, you could use IV rank. And IV rank is a very powerful tool to gauge implied volatility, because let's say, for example, you want to look at the implied volatility for a certain stock A, let's call it Coca-Cola. Coca-Cola doesn't move that much, right? So it'll have a very low implied volatility. And over the past year, its implied volatility may have only ranged from, let's say, 20 to 50. Whereas if you look at a stock like Moderna, which has characteristically, it's more volatile and has would have a much higher implied volatility. Maybe the historical volatility was between 50 and 100 over the last year. You can't really compare the two. It would be like comparing apples and oranges. So IV rank allows you to compare different implied volatilities of different names by making a number out of 100. So it's a percentage. And the higher the implied volatility, that tells us that the implied volatility for that stock is in the upper bound of that range over the last 1 year. So, for example, Moderna's implied volatility was between 50 and 150. If the current implied volatility is now at closer to 150, its IV rank would be near 100. If it's closer to 50, its IV rank would be closer to 0. So that's how you can gauge the implied volatility for a specific name and easily compare it to other names as well. So now that we've covered in a nutshell what the real strategy actually is, I want to look at the basic components of it, the two components. First one being a cash secured put, but I just want to touch up on the covered calls first. So a covered call is an income generating strategy. And it does have one prerequisite, and that is to own 100 shares of the underlying. So 100 shares of an optionable stock or an ETF. From there, you can sell a call option using that stock or ETF as collateral, and you receive a premium in doing so. But that creates the obligation to sell the stock or ETF at a specific price, so the strike price. So covered calls, very powerful income generating strategy. And they are, like I said, again, a rinse and repeat kind of strategy, because the goal usually is to let the covered call expire worthless, but it is still a bullish strategy. And this is where many investors, I think, misinterpret the covered call strategy, as they don't want to get assigned. So they almost want the stock to move lower. But remember, one of the components of the covered call strategy is the underlying stock itself. And this is going to be another term that you will hear me say quite often for today's session, but you always want to prioritize the capital appreciation of the stock over the income generated. So because of that, covered calls are actually a bullish strategy, because you want the underlying stock to rally. And yeah, maybe you don't want it to rally above the strike price, because that's where your profit gets capped, but you still want the stock to move moderately higher. So that's an important thing to remember. And that's why, again, the wheel strategy is also still a bullish strategy. Even though you don't want to get assigned on the covered call side of it, you still want to prioritize that capital appreciation, because that is going to yield more gains than the income received from selling the calls and selling the puts. So you always want to prioritize that. So moving on to cash secured puts or cash covered puts, they can be used interchangeably. So cash covered put is an income generating strategy, but it's also a stock acquisition strategy. So you'd only really want to use the strategy on stocks that you want to own for the long term. And this is where I do view it as a bit more of a short-term bearish and a longer-term bullish strategy, because you are short-term bearish on this because you want to get assigned. So the prerequisite for this is to have cash readily available to buy the stock or the ETF. That is known as collateral. And from there, you would sell a put option using the cash as collateral, and you would receive a premium for doing so. This does create an obligation though, and that would be to buy the stock or the ETF at a specific price or the strike price. So normally when it comes to the cash covered put, you do want to get assigned. And generally speaking, options traders, when they hear assignment, it has a very negative connotation, right? You don't want to get assigned. But for this strategy specifically, the goal is actually to get assigned, so you can gain that longer term exposure of the asset, and you get to participate in the capital appreciation of the asset over the long term. And you also get to sell covered calls to generate additional income in doing so. So one thing I want to say about the strategy is, even though you are buying the stock or the ETF at the strike price, always remember that because you sold a put option, you get to offset that cost basis by the premium you received as well. So it is a much more efficient way than simply buying the stock outright, but it does require a bit of patience, as you'll mostly only get assigned a lot closer to expiration. The downside of a cash secured or cash covered put, and I think there's actually two downsides. One is the stock actually going all the way down to zero. That's that's really an unavoidable risk if you compare it to just simply buying the stock outright, right? Because at both times you're still going to be exposed to the underlying. And the wheel strategy or the cash covered put, these strategies, they don't cancel out the risk. They only mitigate the risk by reducing the cost basis and reducing your maximum loss for the trade consistently over time. But the more well-known or the more frequent risk that you may face when using a cash secured put is the missed opportunity, where, let's say, you actually don't get assigned, and because you're selling a put option with a strike price below the underlying may not move below the strike price and may actually stay above it or even move a little bit higher. That's a missed opportunity, because yes, you receive a bit of premium, so it's not that bad, but you'd have to rinse and repeat that strategy. You receive more premium, but you may have to increase the strike price. So you're actually buying a stock for a little bit more expensive than you would have let's say a month ago when you sold your original cash secured put. So those are really the two main risks to know about the cash secured put strategy. But it's not the worst risk because you still are receiving premium along the way. So you still are generating that income stream. So I want to go over a quick example here. We have stock ABC currently trading at around 50. And let's say I am a stock only investor. So I have a bullish view here on ABC. I'd like to buy it and I'm going to buy it for $50 a share. So I place the buy limit at 50. And because I see, okay, this was a previous area of support that might turn as resistance at around 58. I'm going to make 58 my sell limit. So what does this represent? It represents a maximum risk of 5,000 because remember we're purchasing 100 shares of ABC. So you purchase it for 5,000 and that stock could go to zero, meaning you lose all your money. And your maximum reward would be 800 because again, 50 to 58 is an $8 profit per share. So I want to build on this example and I want to compare the performance of, let's say, a stock-only investor compared to a stock and options investor utilizing the wheel strategy. So for simplicity, we'll call the stock-only investor investor 1 and stock and options investor investor 2. So on day 1, ABC is currently trading at $50 a share. So what investor 1 would do is to set up a buy limit order for 100 shares of ABC at $50 a share, and they are filled immediately, debited that 5,000 for those 100 shares. Now, investor 2, what they would do is they would simply sell a put option that expires, let's say, in this case, 30 days from now, with a $50 strike price, and they are receiving $3.15 for that, which translates to $315 in total. Remember, you have to times it by 100 shares. That's $3.15 per share. So what does this mean? It means that investor 1 owns 100 shares of ABC at 50, whereas investor 2 receives some premium, but also creates an obligation to buy 100 shares of ABC at that strike price of $50 per share. Also, investor 2 would also have to keep that 5,000 as collateral to purchase those 100 shares. And straight away, you can already see the difference between the stock-only investor or investor 1 and investor 2, where the stock trade has a break-even of 50, whereas the option break-even is now 46.85. So that is significantly better than the stock break even. And that's just from selling, let's say, one put option. So this is really what the wheel strategy does. It consistently reduces that option break even. So let's say 30 days go by and ABC has increased by $1. So that represents a 2% gain. Investor 1 sees a 2% gain on his investment of 5,000 to 5,100. And investor 2 sees this the put option expire worthless because ABC did not move below that $50 strike price. So therefore, that has expired worthless. They were not assigned. They keep it full premium. And that full premium represents around a 6% gain already. So already investor 2 is outperforming investor 1. Now, let's say that was the option expiration Friday, and then come Monday, investor 2 decides to rinse and repeat the strategy. So ABC is still at 51. And what they do is they sell another put option with a 51 strike, and they collect $3 worth of premium for that. So 300 in total. The collateral has now increased to 5,100 because remember, it's a $51 strike, not 50. So you need 5,100 to buy 100 shares. But they also receive another 300 on top of that. So what does that do? It reduces the option break even further by another $3 from 51, not 15. And let's say in 30 days time, ABC actually declines. So it declines below that 51 strike and it's now back at 50. So what does this mean? The investor one is now still break even because they purchased it at 50, it's currently still at 50, whereas investor two gets assigned. So they are now obligated to purchase the shares or 100 shares of the underlying at that strike price of 51. They still technically get to keep that premium, but they have to dish out 5,100 to purchase those shares. So they're debited 5,100, but they're still up or compared to investor two by around 10%, thanks to the two premiums received of 315 and 300. But you do want to subtract that minus 100 from the original 5,000 collateral that was posted a month ago, 2 months ago. You want to subtract that 100 because you only purchased it at 51 instead of 50. But they're still up 515 on that original 5,000 collateral, which represents roughly 10%. Now that the investor two has the shares, they're going to start selling covered calls against it, right? So they want to generate more income from that. They want to generate a consistent income stream. And investor two decides to sell a call option, the $55 strike, expiring 30 days from then. And in doing so, they receive $200 of more premium, whereas investor one, they decide, okay, enough is enough. I'm going to place a sell limit order at 58. So ABC is still at 50, so it still has quite a way to go to reach that 58 level. 30 days later, that call option expires worthless because ABC only did rally, but it only rallied to 52. And this means that the stock only, or investor one, they have a 4% gain, up $200, whereas investor two is now up $915 if you take into consideration all the premiums received, as well as the capital appreciation of ABC, because remember, they bought it at 51, now it's at 52. So they made 915 already from this, which represents 18% of the original 5,000 collateral. Now, let's say the following Monday, investor two decides to rinse and repeat the strategy and sells another call option with a $55 strike expiring 30 days from then. They receive $2 or 200, and that again is added to the overall P&L and also reduces that option break even further. So in a matter of just over 3 months, that option break even is almost reduced by $10 compared to that stock break even, which is still 50. And 30 days later, we see ABC rally quite significantly. Maybe someone tweeted about it, who knows, but ABC rallied quite significantly all the way to 60. That's a 20% gain. And the stock only investor one, they get out for an $800 profit because they bought it at 50, sold it at 58. Whereas investor two is now assigned, and they are assigned at 58. So they have to sell 100 shares of the underlying at the strike price of 55. And in doing so, they are credited 5,500. So it's still, in this case, a positive outcome, right? Because they bought it at 51, they're selling it at 55. And they made a lot of premium along the way. So if we take a look at the overall performance over the last 3 months, investor one had a 16% return of 800. That is pretty good. But investor two had achieved a 28% return of 1,415 because, again, you add up all the premium received, you add up the capital appreciation or profit on the stock itself, you get 1,415. So that just illustrates how much more powerful the wheel strategy can be when compared to only investing in stocks. Even though ABC moved identically for both of them, for both investors, investor two was able to maximize that move a lot more than investor one. Thank you so much for watching. We're very excited to introduce our brand new wheel strategy course, which is not only a great strategy to generate a consistent stream of income for your portfolio, but also allows you to purchase stock at a discount. To sign up and learn more, simply check the description below. Also, we will be giving away the course for free to one of our subscribers. Simply comment below with "Teach me the wheel," and good luck.